Okay. Welcome back to another podcast episode of Claims Denied. Today, super excited to be joined by CEO and founder of Indigo. Is it Indigo Health or just Indigo?
Indigo Technologies.
Oh, gosh. See, there you go. It's my bad. But Jared Kaplan is joining me today. Jared, how are you doing today?
I'm great, Blake. Thanks for having me, and looking forward to our chat here.
Yeah, likewise. Especially because InsureTech, I don't know if you consider yourself InsureTech, but that's
Absolutely.
okay.
But we're
fantastic.
3.0. We're InsureTech 3.0. We've seen a couple eras of InsureTech, so we're trying to claim this next era, which I call InsureTech 3.0.
Okay. I love that. So 3.0, walk me through what was 1.0 and 2.0 and what gets you to 3.0.
1.0 was InsureTech, but no one had coined the phrase yet. So that was, actually, I built a company called InsureTech back in the InsureTech 1.0 days, which were largely driven with streamlining the distribution online. So going direct to consumer, direct to small business, and then working with carriers as an in-between, as a brokerage to automate their workflows and their underwriting black boxes. So that was 1.0. 2.0 was during the ZERP era. That was unbridled growth with tremendous optimism that technology could drive both rapid growth and profitable underwriting. I would say the exponential growth piece of that became very, very true. And 3.0 is, it's no longer nice to have the bottom line. So you got to grow these businesses fast, but they have to have the edge in being able to risk select better than the incumbent. So I think we're in 3.0 right now.
Okay. That's good to know. And before we get started, I just got to ask, what makes you this big of a masochist to just be in insurance your entire career?
Well, it's not my entire career. So to be fair to myself, the first half of my career was I spent as an investor. Actually, even going before that, I started at Goldman in their tech, media, and telecom group, working with the sexiest companies in the world. And then I became an investor working with the least sexiest companies in the world, back office processing, HR administration, and insurance. And the epiphany was that they were the greatest opportunities to disrupt with the least amount of competition and capital chasing it. So I think that was some of the insight that led to the founding of InsureTech out of that incubation shop that I was working on at the time. And then since then, I've been a tech entrepreneur, really solely focused on the most boring industries, and then attracting the best product engine data science talent to use new school technology to disrupt these old school spaces. And insurance is like, one of the old school spaces. So there's a lot of fruit to bear there.
Yeah, absolutely. And sorry, I didn't mean to make that encapsulate your entire career, of course.
That's okay.
So Indigo, let's talk malpractice. You already mentioned kind of like the thesis and framework for what you were looking for. What attracted you to, malpractice in particular? Maybe walk me through kind of the current landscape, what's broken, and we can kind of go from there.
So MedMal is like the last bastion of insurance that has not kind of found the fountain of youth through AI, machine learning, and automation technologies. It's a big space. So the space as a whole is about $13 billion. Half of that is independent physicians seeking medical malpractice insurance. The other half is largely facilities, hospitals, who buy excess insurance over their self-insured retentions. The space is dominated by a handful of excellently run players, but it's highly, highly concentrated. So 3 companies own a third of the market, and 2 of them are merging. So you'll have 2 companies that own a third of the market. And then you've got another 5 or 6 that own the next third of the market. And this is the physician side. And then you've got the last third owned by about 100 companies. So it's highly, highly concentrated in a handful of companies. The product is expensive. So it's often the second largest expense for a physician. It is a pain to procure. So we're still asking physicians to fill out 15-page apps with 300 questions. It's slow. It takes days, if not weeks, to get a quote back. And then the underwriting is very traditional. We say it's archaic in that you're using specialty geography, claims history, and board action history to essentially underwrite the physician, and it's not really being done at the individual risk layer. So like between all that, we saw a tremendous opportunity to streamline the whole process, better risk select, save doctors a bunch of money, and not have them sacrifice claims coverage or management as a part of that. And then the related world here is on the facilities. The hospitals are under tremendous pain. So the thesis has always been build the technology and go disrupt the physician market, but then commercialize the technology to help the self-insured healthcare facilities and physician groups better understand what risk lies within the organization. Can they better risk manage that? And can they ultimately reduce their profile over time to reduce losses? Because you're seeing like these tremendous nuclear verdicts. I think Jefferson, New Jersey saw $108 million nuclear verdict the other week. And
Mm.
unfortunately, that's becoming more the norm with all of the litigation funding and social liberalization of juries and other trends that we see across some of these heavier liability lines.
Yeah, and that's so interesting. I do feel like there are these malpractice claims that are just like huge. Like I think I saw Ardent Health had one, maybe Pernuvo had one, or maybe
Yeah,
that's
yeah.
going through court. Those sorts of, so they take a long time, and it's maybe like one or two doctors. How do you kind of solve for like the capital side of that and being a startup? Like how does kind of the financing mechanism work?
Well, when you're small, I mean, it's a high severity, low frequency line. When you're small, you're exposed, right? You can get hit with a claim that is large, and that can be very problematic when you're small, right? So you do whatever you can to defend against that, and that is starting conservatively, right? We're fortunate to have fantastic capital partners. We've raised about 100 million bucks to date, and we have tremendous reinsurance partners who have bet on the business, which help reduce the upfront capital load. But it's every single day being very thoughtful about who we quote and who we ultimately bring onto the books, and just trying to build scale in a very thoughtful way so that we don't introduce risk that we don't want to introduce. And then you just got to get bigger as fast as you can in the appropriate manners. And at some point, you're of scale where the shock loss is less scary. So day one looks a lot different than year one, and we're in year three right now, and we feel really good about the scale that we've been able to achieve over that period of time to prevent against the classic problem, which is a fluke claim on a small book.
Sure, sure. Yeah, it makes a lot of sense. And so you mentioned you're in year three, so that's awesome. And I know you guys, this is somewhat timely because you guys also announced a Series B and a $50 million raise from some great investors.
Yeah.
So I'd love to learn more about kind of, Indigo's journey to date and maybe walk me through the history and maybe kind of, the business model and the various components. And then maybe we can go from there and kind of be more future looking after that. That works for you.
Sure. So the company was incubated by investment from Rubicon founders in Nashville. Rubicon's a healthcare-focused fund run by Adam Bowler, who is a storied investor and entrepreneur himself. They had seen some dislocation in the market that made it interesting. Adam and I used to work together at the incubation shop I talked about at the beginning. So he gave me a call to help advise as they were kind of forming the thesis, and I was really intrigued and put my hat in the ring and say, "Hey, bring me on. Let's do this together." And I liked it for all the reasons that we talked about earlier, which was it just felt like a big space that was dominated by a handful of players that hadn't really invested in technology. There was not a lot of private equity investment in the space, and some of these new tooling, right? This ability to basically rip up the application. So, like, that's what we did. We don't have this 15-page app. We use a doctor's MPI to score the risk. That's all we need. So it's super efficient. And then there had been years of work that predates me joining the company where we discovered 1,500 or so attributes that are highly predictive to risk on a specialty and a geography basis. It differs on each specialty and each geography. It's very complicated, but that was very cool. And then also we were able to aggregate about 60% of the medical malpractice claims over the last 10 years. And so, the first iteration of the model, when I looked at that, I was pretty floored because it was highly predictive. We could figure out the 20% of docs that drive 60% of the claims on a specialty and geography basis. And I had just built the lending business previous to this. Lending is very similar to insurance. The cash flows in the opposite direction, but in lending, you're sending it away. You hope it comes back. In insurance, you're grabbing it. You hope you never have to give it up. But we built a very successful company there. Ultimately took it public, and the model was never as predictive as this was. So I was like, okay, there's some real foundation here, and then jumped aboard. Year one, it was about building the technology and making sure we had the right distribution relationships, and then proving everything that worked in the sandbox worked in the real world. Because you do this, you back test it. It looks unbelievably predictive, but you get out there in the wild, wild west, and you have to prove that it works that way as well. So That was year one. We stood it up at the end of year one. Year two is working out the kinks, improving the model. So several iterations of the model, building the team. We front loaded the team here. It was the right answer. You can't expect to win the credibility of doctors and reinsurers if you don't have incredibly prudent people on the team. We hired a team that has deep medical malpractice insurance expertise, but also deep product engine data science expertise in more financial technology related companies. And so that took some time. Then, we were rocking and rolling by year two. I think year two, the hardest thing was the technology work. The model was proving to be quite predictive. It is a longer tail line, so you need 2 or 3 years to actually start seeing those claims frequency curves. And we started to get very confident what we were seeing there. Then you got to prove to people you're legit. You're competing against folks who have been in business 100 years and have $1 billion balance sheets. And so, Indigo, I've never heard of these guys. Who are they? Hey, we're great guys. You should work with us right now. I mean, it's more than that. It's not just about price. It's about confidence that if we can save you money, we're going to be there when you have your toughest moment. I mean, doctors are all going to get a claim at one point, and that's a very scary moment. And they want to have an insurance partner that is going to be credible and help them do that. So I would say like that second year, it was very frustrating because the value prop, especially for some of the larger deals, was clear, but we weren't winning it as often as we should have. And then we flipped the calendar to year three. I would say it is happening more and more now. And you know that because we've upset a lot of the incumbents in the space, which is always a good sign when you're small and, your distribution partners are getting threats that you've struck a nerve and you're really onto something. And so that's where we are on the business. And now that we got this, we went into the Series B raise, kind of showing off these proof points. And I can't tell you how many times I got asked in the Series B, when do we see exponential growth? And I was like, we could do that tomorrow. We're probably going to blow up the business in 3 years, but everyone's going to feel great in the next 2 years. So let's not do that. Let's build, this very rapid growing company for the space. We're far and away the fastest growing company in the space, but prudence so that like every month the cohorts get a little bit larger. And so you don't introduce these variables. And I think that was very helpful during the Series B. We started having conversations, late first quarter, early second quarter last year. We ended up closing the deal at the end of last year, but we essentially showed people a plan that, every month we came back and we hit. And that's critical to building our own credibility and then getting the capital in there so that we can now kind of take this business to the next level, like continue to just execute like crazy on the core business, which is being an insurance carrier for physicians, but then also expand the TAM to some larger risks, to some facility business, and then commercialize the technology for the self-insured folks in the ecosystem who really can utilize this. It's a slightly different way that we're doing it, but with the same result, which is reduce your liability without, shaking up too much of what you got going on internally.
Yeah, well, what a journey. That's incredible. And one of the first things you mentioned was kind of finding the right distribution partners. So wondering if you could kind of break down what does distribution look like in MedMal? Is it kind of like brokers? And I assume that varies between kind of, independent groups or, onesie twosie docs versus a health system that are kind of self-insured. How does all that kind of play out?
It is fascinating. So we sell 100% through insurance brokers. Very, very traditional. By the way, we already got the sexiest technology in the space. It is amazing. It is getting better and better. Without the relationships with the brokers, you got nothing here, right? Like even if you wanted to go direct, I mean, there are certainly doctors online that are looking, but they're typically not the doctors that are going to be core to, the way you want to build an insurance portfolio. And they're smaller, so it's hard to scale the business. So we recognize that day one, we got to go and build relationships with these brokers. And rightfully so, like doctors are making life and death decisions every day, right? So they need a trusted partner to help them figure out, which is a very complex world, this medical malpractice world. So that made a lot of sense. We have some folks on the team who literally grew up in diapers in this industry and have deep relationships. My chief sales officer, Travis Watts, who's done a fantastic job. He literally grew up in the industry, and we leverage his relationships. We have two gods of the industry on the board, Howard Friedman, who's ex-Pro Assurance, and Bill Fleming, who's ex-TEC. And they really helped with our credibility so that we could tell the story to the brokers. By the way, they all asked us, well, how do we know what your appetite is? And we're like, okay, we're going to work a little differently. We want to see everything, but we're going to tell you very, very quickly whether we like it or not. Well, what specialties like? We like all of them. Which geographies you like? We like all of them, but we want the best 50% of every specialty in every geography. So that took a lot of education, but we were able to build a highly curated distribution network here. And I would say it's there are national brokers who are very big in the space. There are regional brokers. You also have, mom and pop shops that are exclusively focused. Even the national guys who have acquired the medical malpractice brokerage expertise, they've literally left it alone. It's very siloed. So even though physician offices clearly buy other lines of insurance, MedMal has continued to grow up to be very, very siloed. And so we know who the players are. There aren't like thousands of players. There are hundreds of players, and we needed the right partners. And we've done that. I will say it's obvious to see who has bought into the product because you just look at the conversion funnel. We did 7,000 submissions in 2025 with 4 underwriters. So it's a lot of submissions, very few underwriters. We're very, very efficient. When the conversion funnel works, we quote about half of what we see, and we will bind a quarter of what we quote for our best partners. And that's the business that we want, that we're winning. We're not getting adversely selected. You actually could do a lot better than that if you flexed on price a little bit. Then you're jeopardizing your loss ratio. So that is a very healthy conversion funnel. So we see in our partners, right, those that are converting like that versus those that convert differently. And that is just kind of different phases of people getting comfortable and trusting us. And so it's a journey. By the way, the first time you turn on a distribution partner, you don't see their best stuff. They're kind of checking you and seeing if you're going to be like the company that comes in and just writes everything to gain scale. I think it was hard because it slowed our growth at front, but we really were disciplined in not straying off of this like very proprietary algorithm that we're able to build and sticking to our guns. So that enabled us to actually build more trust. And as a result, we've been able to grow these relationships over time.
It is funny. I feel like every time I talk about technology or there's a panel or whatever, it's like you can have the best technology in the world, but if you don't have like the human component in healthcare, the trust and the, all of those people who know what they're doing and the data to back it up, you can't go anywhere. So,
and there's just there's a psychological component of this stuff, and why brand and credibility matters. Like I'm in Miami, and homeowners, has been very expensive here. Obviously, there's actually a lot of capacity coming into the marketplace, but I moved about 3.5 years ago, and I remember I got my first homeowners policy. I was like, "What is going?" I'm like, "Am I in a flood zone?" I'm like, "Oh yeah, I'm like technically in a flood zone, but I'm like in like the least likely to flood zone," and like it was still ridiculously expensive. And then the next year, I got a quote for like half of what I was paying, and so my initial reaction was that like, who is this fly-by-night shop that's trying to win my business? So then I downloaded the policy form. Like I'm in insurance. I put it into my 3 favorite AI tools. I'm like, what am I missing? Am I getting less coverage? Are they not financially stable? And then I had to call my broker. I said, like, what am I? And then all of a sudden I looked in the mirror. I was like, oh my God. Like this is the reaction to Indigo every day, right? But it was very, very telling, and you have to pay particular attention to the soft value prop. Like it's not just saving people money; it's saving people money and being credible, and that takes time, right? You can't just like be viewed as, oh, it's a privilege that Indigo insured me because they say no to a lot of people and they said yes to me. These guys maybe don't know what they're doing. So anyway, that is like the insurance is absolutely. It's challenging because you can build the best technology, but without that credibility and if the brokers don't believe in you, they're not going to pound the table for you with the docs. You're not going to win it because the docs are looking for someone to say, okay, like here are your options. These guys are a little bit less because you're not going to win it in most cases if you're more expensive, unless you're moving them from an E&S market or, you're changing the structure of the policy.
Mm-hmm.
And yeah, these guys are legit and you should do this. You should feel comfortable they're legit. That's what we need.
Yeah. Yeah, I love that. That makes a lot of sense. And love the kind of, empathetic, you're able to kind of see the other side of the mirror there, the other side of the kind of buying equation. I'm curious, just like, because we've hit on kind of, especially when we talk about, insurance 2.0, which was the ZERP era, grow at all costs, right? And you guys, are taking a more measured approach and trying to be more prudent. But there are also, I imagine, both internal growth expectations and external, investor growth expectations. But then you also layer in how you want to have good relationships with brokers. And so how does all that work? What determines whether you say no to a group? Like, can you pick certain providers within that group to cover a cherry pick? I assume not, but like, how does all that kind of work? If that makes sense.
That's an exception to the rule. I mean, we do individualize the pricing. So like if you have a 25 doctor group, we have an individual risk score and premium for every single doctor. Most groups want us to blend it, right? There are several that say, hey, can you show us the individual premiums? And then they can have their own internal discussion. And then there are times where we can have a conversation, just, hey, we got to carve out a doc or two if we're going to make this work. But that is by far and away the outlier into how we do business. And the way this works is, so based upon the MPI, we run a highly sophisticated model behind the scenes that tells us what the risk profile of that doc looks like in comparison to the average doc in our cohort. So the best way to think about that is in, I don't know, pick your favorite. If you were Omaha, Nebraska, and you line up all the gastroenterologists, right? Like we know every gastro in Omaha. We know their MPI. We've scored them all. And we know what the average doc looks like, which would be a 1.0 in our risk nomenclature. And then we know the docs who are below average, and then docs who are above average and way above average. And what you find, although it does differ based upon specialty, but certainly if you go more surgical, you're able to isolate the vast majority of claims in a small percentage of the population. And so we look at that cutoff, and it's just a non-starter for us. We're just not going to be a market for those that are past, in the highest risk bucket, the highest 20% risk bucket. By the way, highest risk doesn't mean you're a bad doc. It could mean you're the most talented doc doing the hardest cases for the most complex populations, and therefore the probability that you have a bad outcome is higher. But from an insurance perspective, right, we may not feel like we can get the price for that risk. Whereas in the remaining 80%, you find that the rest of the market kind of views all those players the same. And so the standard deviation of pricing is very narrow. And our risk model is highly stratified. And so for about half of that population, we can save 50% or more. And based upon that risk score that we generate, I got a very good idea whether we can save you money before we do any of the work. So that's what we're doing. The brokers are submitting business to us. They're typically just forwarding whatever went to another market. We have intelligent data processing technology that grabs the pertinent information, puts it in real time into our proprietary platform, which we call Lux. And then Lux spits out the risk score, the premium, and then other very interesting facts that we could find about that doctor that may also be relevant to the underwriting profile. Today, we announced publicly at the end of last year, about a quarter of the business was, all the decisions were automated. That's significantly higher here by the end of the year. Half the decisions will be automated without manual oversight. There's still a number, especially in this particular niche, where you want to kick it out and have someone take a quick look at it. But that makes it a very seamless process there to figure it out. So, all being said, that's what we're trying to do. We want, call it the top 40, 45% of the population. And if you're in our risk appetite, we can save you a lot of money.
Great. Makes a lot of sense. And you mentioned earlier kind of, the nuts and bolts that goes into the risk score that's individualized by physician or clinician. You mentioned kind of like, there's 1,500 attributes, and it varies by geography and it varies by specialty. I'm just curious, were there some factors that played into that risk score that you didn't expect to be there?
I mean, there's a lot that's intuitive. There's a lot that's counterintuitive. Well, we can start with the easy stuff, like the intuitive stuff. Pretty universally, if you're a family medical doctor prescribing opioids at a benchmark, at a rate much higher than the benchmark, you're going to be prone for a future claim. Then the counter intuitive stuff, we find that political leanings can actually drive it in a particular zip code. The shift of red or blue to red seems to be rife with the ripe with the potential for additional claim activity. So that's kind of fascinating. That's interesting. It's not something I thought of. Who you work with sometimes is a driver, right? Who you're affiliated with. That is not always intuitive, but can be counterintuitive. And then, depending on the specialty, how often you diagnose something, what your patient population looks like, actually could sometimes be counterintuitive. I'm not sure if I have any great specific examples of that, but sure. I will say, like, the differentiation between us and the incumbents is that if you walked into a four-walled, a 5-person nephrologist group in Topeka, Kansas, and those were 5 doctors. They were all claims free for the last 10 years. That's generally viewed as a pretty mild risk. We wouldn't look at it that way, right? We would look at their individual patient populations and their procedures and their prescription patterns and a whole bunch of other information. And we very well may see someone who has been an incredibly clean risk as a ticking time bomb. And the reverse is also true. Like a doctor that just got a claim, we're able to tell in many cases that it was a fluke and all the markets are freaking out. And that's a pretty good opportunity for us to win the business.
Yeah, fascinating. That's very cool. And I'm just curious, just because I also, write and learn about like value-based care and quality and those sorts of things. Have you guys like thought about and or done any research on like, hey, how does our model stack up to like quality of outcomes from a physician and those sorts of things?
We're just starting to look at the Venn diagram there and understand the overlap. There absolutely is an overlap. I think a lot of what we look at is it is a derivative of quality. I mean, these models are incredibly sophisticated, and so we do believe there is a triangulation that relates to that. Quality and medical mal risk are also very separate as well. So where it does potentially make sense is if you can truly separate between negligence and a fortuitous event, that is very, very helpful, right? It's hard to avoid a fortuitous event, but if you're negligent, uh, once you're more likely to be negligent again, and so that is at the crux of the holy grail here is to be able to actually figure out that bright line, and we are on the path of that, but there's a lot more work to do.
Yeah, that's I was just curious.
Yeah,
Maybe the first question I'll ask, and I don't come at this from an adversarial perspective. I'm just curious for your perspective. There's been on the health insurance side, just like a lot of talk around like denials and like AI driven denials and things like that. Are you concerned, I guess, from an optic standpoint around like using AI and applying it to MedMal or applying it to healthcare? I guess if that makes sense. Like, have you experienced any pushback?
for sure. You're always very concerned about disparate impacts. The regulatory bodies here are actually a lot further along in thinking about this on the consumer side than they are on the business side. But there's a lot that's going to be decided, regardless of where that all ends up. There's always headline risk, and that actually can be more painful than the regulatory risk. So we are very conscious of it, and we do test the models for disparate impact and try to get ahead of any biases. We are highly confident in the way we're doing this stands up under scrutiny. And at the same time, we're always improving and evolving the model. So it's a constant game of ensuring that those statements are true. So we're absolutely aware of it. And, when I was in consumer lending, it was a non-negotiable. There are very tried and true methodologies and tests that you need to be aware of to ensure that there is not disparate impact. And I would say like we're applying a much more scrutinized filter on top of what we do versus what you would, be mandated to do today, because we all know this is an ever evolving world and you want to be ready for whatever comes down the pipe.
Sure, absolutely, absolutely. And kind of on that note, being ready for what comes next in the world. There's been a lot of talk recently around like agentic AI, right, and an operating leverage and those sorts of things. So I'm curious from your perspective in operating Indigo, where do you like absolutely for your business? Where do you absolutely need humans in the loop, or you need humans versus what aspects have you either outsourced and or automated to kind of capture that leverage?
You absolutely need humans. I would say the productivity of humans over the last 5 years, let alone the last year, let alone the last 3 months, it is crazy what is happening. I mean, we have such a benefit by being a clean slate and not having all of the baggage and bureaucracy and hierarchy of some of our competitors. That is a very hard thing to reverse. There is not an area of our business that is not touched by technology, and we continue to find use cases of how we can double down or triple down where we're at. We even myself, who thinks we're pretty into this thing, like we were talking a couple weeks ago at our product eng meeting about there's some off the shelf software that we've purchased, and it plays a role in our stack, and we have issues with it from time to time. And I think I made the comment of I don't really want to spend our resources on that. Yeah, like maybe we could do it better, but it'd be distraction, and like we should do something else. And like our lead engineer was like, well, thank you for your thoughts, Jared, but I spent 3 hours this weekend on something, and let me show you what I built. And I was like, all right, let me see it. And I was like, forget everything I just said. It's all on the table. It's just crazy. So the thing is this, we are highly, highly automated. The decisioning is getting more and more automated. The job of the underwriters at Indigo look a lot different than they do elsewhere because our underwriters are helping us figure out how to take all this complexity in their brains and through the technology that's available, make as good a decision as they can make. And that's just, I don't ever say never, but I think we're nowhere near close, especially in medical malpractice, to 100% of the time being able to figure that out. What's key is getting as much of it you can done by the machines and then figuring out where to kick out for a human to make a quick decision. And so you can even see with our stats, I mean, to do 7,000 submissions with 4 underwriters, and we weren't 20% automated until the end of last year. Like, there was still a lot of manual process happening behind the scenes, but it was in increments of time versus where you'd see elsewhere in the industry where you were doing the whole thing soup to nuts. So, and beyond underwriting and beyond intake, right, where there's a lot of automation, you got to think the whole policy life cycle, right? Servicing an account, all of the pieces that you need to touch, during the life cycle of an account, whether it's an endorsement positively, an endorsement negatively, renewal business, requests for loss runs, general service questions. These are all activities that can be greatly helped with AI. I mean, our industry, MedMal, you should see the broker portals that exist in MedMal. I mean, it's like the medieval times. So there's a lot of low-hanging fruit there to action on and enable self-service. So that's a huge part of it. Claims, right? In this world, virtually all claims are litigated, right? But trying to figure out a case and the carrier's position versus the physician's position and basically synthesizing all the data that goes back and forth, that can be like readily helped with AI. I still think it's art, as much art as science when you think about what the total cost of some of these claims could be. But that doesn't mean that you can't use tools to help you kind of figure out what the bands of possibility are. So there's tremendous amount there. We work in remote culture and we use a lot of these tools to like build culture remotely, which by the way, I think is like as important as their technology is how you get a group of people to work really, really effectively with each other. So it really runs the gamut across the board. The Model 2 is heavily influenced by your ability to use these tools to go through and then to build the agents that are required to kind of go get additional data along the way to make a decision. It is untouched. We really don't have to hire anymore. We can scale off this base because so much of it is automated. And I think that is what you're going to see is you're going to see many, many more companies that are smaller. I think that's actually a great thing for this country. We're in a very scary moment about what's going to happen to jobs and all this stuff. From our perspective, we're just making our people more productive because we had the benefit of kind of being thoughtful about who we added as we saw this technology coming on. So for us, it's much more about keeping the company small and leveraging our people with the technology than it is replacing our people.
Yeah. And so that's interesting that you say that you're no longer, maybe on some fringe cases or whatever, but for the most part, not going to hire. Like, you've got your core group of people. How did you know when you're at kind of like critical mass? And now, I guess, with, the dawn of automation and these sorts of things, when you're identifying problems, you're thinking about building those solutions internally rather than buying them or partnering on them. Is that kind of fair to say?
Yeah, we're very highly metriced. We run the business in real time. We've got data across the board in real time that allows us to figure out how the supply chain is working. Our supply chain is submission to quote, to bind, to service, to renewal, to claims management. The technology, you build the technology, but the business is growing at the same time, and you have a people component. So you're always kind of juggling, we're growing fast. The technology's helping take some of the workload off, but we don't have enough people. We're going to have a service issue, right? So we're always juggling, and it's not a straight line. Also, our business is seasonal, which is tough, right? Most of this business renews July 1st, January 1st. So you got peaks and valleys you got to deal with. And when I say we're no longer hiring, it's not Zero. I'm just saying,
Sure.
we got 40 people today. I'd be surprised if the business ever has 100 people. So we're just much more prudent about it. But uh, but we look at those metrics, right? We're looking at, okay, we got how much submissions coming in, we're quoting how many times now is the service team tasked with doing something, how many of our customers are on auto payment versus not. Like auto payment is great because you get less non-pays. You get non-pays, you got to chase. By the way, there's very few companies in the space that actually let you pay with credit card, which just shows you. Like we're talking about like
Wow.
tech. So anyway, that's what we do it, and we're constantly looking at it and trying to get it right. You don't want to burn your people out, and especially when you're keeping it small. People have to have the ability to advance, right? Which is the other thing. Like when you think about building an environment with high morale, like there's got to be a mission. People got excited what they got to do. They got to see growth. Thankfully, with these tools, there is a lot of growth and a lot of learning. We're on the cutting edge of what is happening out there. Like a lot of people call themselves an AI company. We are doing it day to day with our own engineers, our own data scientists, our own product folks, and it is awesome what we're able to accomplish and figure out. And you get a lot more, rope to play with in our parts because we want to test these tools, and that doesn't mean we're not compliant and thoughtful about all the ways that they can go wrong. We can, but it's just we can move so much faster than everyone else, and in this day and age, that's a huge advantage.
Absolutely. Absolutely. Just the nimbleness of new startups is pretty astounding and alarming. But I do want to go back to that kind of more theoretical question around jobs displacement and those sorts of things.
Yeah,
Because from your lens, or from my lens, I don't know, whoever's lens, let's say Indigo is successful and continues to scale. And I hope that's the case because you guys, provide value to your customers and lower price and more prudent pricing and those sorts of things. But like that eats into incumbent market share,
yep,
right? Because there's only a certain pool size for these things. And those incumbents are incredibly inefficient. Maybe experience is worse, but they also have employ a lot of people, right? And so I'm curious for your perspective on like, as you guys are continue to be successful, it creates like jobs displacement and maybe value accrues to fewer people, but the people who are creating more value for the customers. But economically, it's kind of this weird equation where, maybe more people are out of a job in something they've been doing for 20 years or whatever. And I think maybe across healthcare and across these incumbent industries, insurance especially, there's a lot of jobs loss potential. So I'm curious, like, I don't know if I necessarily have a question here, but for your perspective on how that plays out in this kind of new era.
you know, I think everyone's worried that there's going to be this transition period. It's hard for me to like short term. I think things always take longer to kind of get into the market. I think as good as these tools are, they still hallucinate way too large a percentage of the time. They still make a lot of mistakes. It's getting better and better on a weekly basis. But whoever was the best provider, this one last week versus this week is changing. All I would say is I think I am like highly optimistic that jobs are going to change, but they are going to be plentiful, meaning like the traditional servicing job or underwriting job at an insurance carrier, those are the folks who are best positioned to help figure out the best way to use these tools to get to the same result. I just feel like, what is important is that people embrace them and understand the power and the downfalls of them and become experts in their domain and how to use these tools. And then they're highly, highly valuable in what this new role is going to look like. And
Yeah.
insurance as a whole is like such a terrific hunting ground for how artificial intelligence can make the process better. There should be lots more competitors, right? And the job activity should be robust. So that is and we see that, right? Like the jobs at Indigo, we compete with the big boys who are the incumbents who look very different from us inside, but like we have the same titles. It's just the job looks a little bit differently.
Sure. Yeah, yeah, I appreciate that answer. And your response sparked another question in me, which I'm also very curious about, which is this kind of talking about use of AI in clinical settings.
Yep.
And I feel like we're kind of entering this era, which to your point, there's still hallucinations, there's still things to work out. But over time, I'm arguing that AI makes clinical care and decision making safer, hopefully, right? So, assuming that future is the case, as somebody who has a vested interest in that from a malpractice standpoint, if there are less negligence, fewer errors, like those sorts of things, how do you kind of price that or like see that kind of playing out, I guess? Like, are you a fan of this happening, or how do you kind of see that trends, I guess, coming to be?
Well, so let's look at auto insurance and homeowners insurance before we look at medical malpractice, right? In homeowners, right, there are certain discounts you get on your homeowner's insurance policy if you have a burglar alarm, right? Or you lock your jewelry in the safe, or you have other protections, water detector leaks, right? There are all these kind of widely accepted practices of how to reduce risk, and you get a better price for that. Okay, that's homeowners. Auto insurance, look at Tesla and full self-driving and some of the stats that Elon Musk continues to tweet about the safety of auto driving versus non-auto driving. That certainly is a very interesting fact. And the more we have autonomous driving, I think the less we're going to have accidents and the cheaper insurance. Yeah. I don't see how it's going to be any different in other lines of insurance, medical malpractice included. It's all about the data. Like, the very impressive thing that Tesla's doing is now they have millions of driving, or maybe billions of driving models that they've been able to test and kind of speak to the incidence of an accident versus manual driving, human driving. I think that data will ultimately be available in healthcare settings, and the vendors that have proven that they have moved the needle will be the burglar alarms of medical malpractice. And carriers should reward customers for invoking those tools. So we fully expect that. And hopefully the incidence of error goes down. That's a good thing for humanity. I think the job of insurance companies will change a little bit. I also think the price of not using them goes up. And there's always a reason not to use them, right? Because there's complicated procedures or processes that require human oversight. Like the car driving examples, if you want to drive your, non-autonomous fancy car, right? You're going to be surcharged for, the full software. So it's going to be worked out all the way. But it's a ways away from it happening, right? We're talking a decade plus, I think, from having the data in medical malpractice and medical settings. But
Sure.
we want to be a first adopter of that for sure. And we're actively looking for, real world data that will give us confidence so that we can actually reward physician groups today for employing them, because we think that ultimately will drive down errors and omissions.
Let's say you could choose anything, like what would be the areas with real world evidence that would move the needle the most from like a price standpoint? Just curious.
Just documentation software that I think is super helpful. Like, just making sure you have the right notes and that you're following the standard procedures of care, and you're following up when you said you were going to follow up, and you're monitoring. So all of the administrative, like, you see that a lot in medical malpractice, which is you have a bad outcome, and then the doctor's liable because they didn't follow standard care, or they didn't follow up, or they didn't have the right, it's a he said, she said of the notes. So there's a lot there that I think is super interesting. Diagnostics are, you mentioned Prenuvo earlier, right? I mean, that was a case where something was not detected, but these tools are getting better and better with the incidence of error for automated review in tandem with oversight from a human, I think should beat the alternatives over time. Once that is empirical, like, that would be super interesting. And then there are, other automated Internet of Things tools that allows you to monitor patients better and kind of act on those. So there's, you see the big case in Utah. You've got auto prescribing. That's more of an efficiency play than it is anything else. I'm not sure if you'll be able to translate to lower errors and emissions, but there's obviously a lot of angles here to take a look at, and
Makes your job harder or easier, maybe over time.
I mean, hopefully it looks like homeowners insurance, where people know, like, it's better to have a burglar alarm versus not. Like, your house is less likely to get broken into. Like, the analogy is like you're going to be less likely to make a mistake and miss something. Now, it doesn't mean you're going to get it right 100% of the time. And so for those cases, you're still getting insurance, of course, but you should be able to avoid some of the mistakes that were unavoidable without these types of tools.
What's interesting is, as you're kind of saying these things and talk about kind of, if you have these certain things that you're doing right, they should kind of reward their customers and those sorts of things. I can't help but also think about the parallel to just health insurance as well, and how, I don't know, maybe it's a little different, but like, if the patient does certain things or the member does certain things, like, should they be rewarded? And should behavior change ultimately be how health insurance is priced or those sorts of things? And I'm not an expert necessarily in actuarial stuff, but the more we talk about other insurance industries and your own, MedMal and car insurance and homeowners insurance, like, feels like we're kind of missing the plot on the health insurance side. And maybe that's a big part of the cost equation. Do you have any thoughts on that?
Well, your question is health insurance costs have increased, far above the rate of inflation here over the last couple decades, and that's causing an issue for.
And I guess, like, to my own point, there are, like, value-based care models and
Yep.
engagement tools that they're trying to use for those purposes. So maybe that's how it's kind of playing out. But I do wonder if there are certain provisions within the ACA that prevent health insurance carriers specifically from deploying their full set of tools from a patient protection standpoint or something like that. So I guess that's what I'm getting at.
Yeah, listen, I'm not close enough to it. I got my head buried so deep into the wonderful world of medical malpractice.
God bless you.
We used to try to say, like, we're bringing sexy back to medical malpractice. We figured that was not the right tagline. But, I got enough to worry about. But going back to my lending days, I do think, obviously the cost of healthcare and childcare and housing and education have skyrocketed. I think they're all problems and all worthy of time to kind of figure out how we decrease costs and improve outcomes across the board.
Yeah, absolutely. Agreed. Okay, back to Indigo. So you just raised $50 million, which is awesome. 100 million to date. You guys are doing well by all counts. What does capital allocation look like for you guys from this point forward with that 50 million tranche? And what does success look like for you guys over the next 5 to 10 years in such a historically slow moving industry?
Yeah, there's a couple ways you build these businesses. When I say these businesses, the AM Best rating is critical in medical malpractice if you're going after the admitted market doctor. Most hospitals are going to require an A minus or greater rating. And so that's expensive. That's very expensive. And then bearing risk is very expensive because you need to hold surplus for future claims. So when we initially set up the company, we made it as capital light as possible. And when you make it as capital light as possible, you usurp the majority of your unit economics, right, to third parties, specifically reinsurers. So that makes all the sense in the world because you could raise $100 million and stick it in the balance sheet and go run AM Best. And that's one way to do it, but that's very capital intensive versus the way that we did it. So we raised the money to continuing to eat our own dog food. Like, we could grow this business a lot faster, but we are growing it prudently because we want to generate unearning profit. And when you generate unearning profit, no one is going to pay you more for that than what it's worth. There's always this disconnect. So cycles change on whether you want to cede the risk or keep the risk, but we are definitely in the mindset that we want to take more risk because we really believe in the profitability and the premiums that we are driving. So some of the capital is got that in mind. There's just a working capital component that we've built a team and we have our own operating costs that the plan for the Series B is to get profitable, right, and control our own destiny. And the third piece is to expand the marketplace. And this commercializing the platform opportunity is huge, especially for the healthcare facilities and the systems, the hospitals. The hospital systems are seeing their reinsurance go away because of the nuclear verdict. So they're being forced to take higher and higher self-insured retention. So what used to be a hospital that took $5 or $10 million is now taking $15, $20, $25 million of self-insured retention. Hospitals aren't running on the biggest margins. Reimbursements are down. So this is a real pain point. And the difference is a hospital is not just going to terminate the high-risk doctors. A lot of those doctors are actually driving a lot of the revenue. And what can our tool, which kind of sees behind the curtain, do to help a hospital? Well, it certainly allows you to isolate risk, the riskiest physicians, and then make sure your risk management teams are understanding the data behind that risk and then managing to that. There is absolutely a component on credentialing, both for employee docs and for just privileged docs, of understanding what that risk looks like. You could potentially not credential or privilege. You could potentially change the scope of services if you understood what that risk looked like. There is the the allocation, the overhead allocation of these insurance premiums, but they're not really premiums. You're basically charging a doctor to fund the self-insured balance sheet. That's typically done peanut butter across all the physicians, where we know that all physicians are inherently, they have different risks, so you could potentially better allocate risk. And then finally, just how you segment and think about buying reinsurance, excess reinsurance. If you have that information, you can have a lot more confidence in what you want to keep and what you want to cede. So we think it's ripe for that, and we plan to pursue that because that's the other half of this marketplace. So and like I said, that there's a ton of pain there. So the capital is here to build that muscle as well. And if we look out 5 years from now, we want to be a top 5 physician insurance company. We also want to have a robust self-insured business that is powering the identification of risk, whether that be a hospital, a healthcare facility, or a large physician self-insured group.
Yeah, that's awesome. Well, super ambitious goals, and I'm really, rooting for you guys, and we'll be following along for sure. Who's the purchaser of malpractice on the health system side? Is it ultimately like just the CFO, or is there somebody?
Well, a CFO is or chief risk officer. They're looking at the market on the price of excess reinsurance and excess insurance or reinsurance of the hospital, and then they're trying to figure out what they want to retain themselves. But they're being forced to. The excess insurance structures of hospitals looks like Tetris. You have 20, 25 providers. Some are taking vertical slugs, some are taking horizontal slugs. There's carve-outs. It is incredibly complicated, and guys are pulling out, and that's because of these nuclear verdicts. So what you're seeing is retentions on your own balance sheet are going up, and you have less access to go after. So that is absolutely a CFO, CRO conversation, and it's causing tremendous angst.
Yeah, it sounds incredibly nuanced. And I know insurance in general and benefits and all the above, physician compensation, that's all super top of mind for health systems. So if anybody's listening to this, wants to get in touch with Jared, he seems to know his stuff when it comes to MedMal. So get in touch with him. Jared, thanks so much for joining me today. I've got one more question for you.
Please.
It's non-healthcare. And I ask everybody at the end of the podcast. And really it's, what's a piece of content or media or whatever, something you've consumed in your life that has kind of fundamentally changed how you live your life?
Well, I mean, my parents have been unbelievably influential in what I've learned, right? So, my dad always used to say patience is a virtue, and he says 2 wrongs don't make a right. So those are 2 kind of values that I live by. My mom, working mom throughout my entire life, I used to give her a real hard time when she told me she'd be home at 7 and she'd go home at 7:30. And so I have a lot of respect now with my own kids myself on how difficult that was, how influential she was. So they were incredibly influential. I think content wise, the 2 books I always think about, Tony Hsieh wrote a book, Delivering Happiness, about Zappos. And then Ben Horowitz wrote a book, The Hard Things About Hard Things, about being a CEO. And those are the 2 most influential books I've read. The Zappos book just being about like what it really means to put the customer first and deliver exceptional customer service. And that can be shoes, and that could also be insurance, medical malpractice insurance. So that's absolutely influential. And then I think the Hard Things About Hard Things is just, in the CEO chair, there are different times of the persona you have to take on and how you act in those times. And you're paid to make the hard decisions, and you should embrace that, and how you deal with stress and all of that stuff. So that was a fantastic book. So those are probably the 2 most influential books that I have read.
Yeah, awesome. Well, as I say to many others, I'm going to add those to my Goodreads and look forward to reading them. And best of luck in introducing consumerism into MedMal. That would be fantastic. Jared Kaplan with Indigo Technologies, thanks so much for joining me. I learned a lot, and best of luck to you guys this year.
Thank you very much, Blake. Thanks for having us.